Sustainable investing merges financial goals with positive societal impact by incorporating environmental, social, and governance factors. This approach includes socially responsible investing, impact investing, and ESG investing. SRI began in the 1960s, focusing on excluding investments in harmful industries like tobacco and weapons. Over time, it evolved to include positive screening, selecting companies that demonstrate strong ESG performance. Impact investing aims to generate measurable social and environmental benefits along with financial returns. ESG investing involves evaluating companies based on their environmental practices, social responsibilities, and governance standards. This method helps investors identify risks and opportunities that traditional financial analysis might overlook. While SRI focuses on ethical exclusions, ESG integrates sustainability into financial analysis, and impact investing proactively seeks specific positive outcomes. Understanding these approaches allows investors to build portfolios that achieve financial success while contributing to societal well-being.
Charly, I want to start with you because you and your wife, Lisa, founded KL Felicitas Foundation, your family foundation, and you created a 100% impact portfolio. Can you talk about the evolution from some of the negative screening to where you are today?
Yeah, glad to do that, Andy. So as you mentioned, my wife Lisa and I have been in the impact space since over 20 years, since 2002. And so we've seen the evolution and have been playing a role in steering it into a direction where we believe we need to change the underlying systems that drive our economy and our financial systems. Why am I saying that? Well, because if you think about the root causes of the multi-systemic crisis that we're in, then eventually you're going to end up with the economic system design and the financial system design. And there's two deadly design flaws. On the economic side, it's that we are driving our economic system as if we could grow indefinitely, exponentially on a planet that's finitely resourced, that cannot go well long term, particularly as we approach 9-10 billion people. And the financial system design's deadly design flaw is that it's only about financial returns at the expense of everything else. And so unless we change that, I think we will just return the crisis that we're in, but more disturbingly, we will get deeper into this crisis. And so our objective is to contribute to alleviating the root causes of these systems. And so when I saw the ESG train coming, just briefly commenting on that one, if I may, about 6 years ago, I was concerned about the positioning of ESG as impact and the confusion in the marketplace about this. I think we're working through that. And I think ESG has its place, so has impact. But I think if you want to go deeper, and I just key that up for a potential discussion later, Andy, I'm not going to explore deeper on that right now. But if you actually want to change systems, including the financial system itself, then you need to go beyond the current impact investing craft and challenge yourself about how investments and philanthropic capital and others can contribute to positive systems change. And the last thought that I want to key up here is that I believe that this change can only be done if we also change our awareness and consciousness, so that we as humans take the responsibility that comes with that and our stewardship for the planet and for society. And I'm looking forward to discussing this also because you mentioned Hawaii and ukulele. My wife is part Hawaiian, and the Hawaiians have a beautiful name for that. It's called Kulana. It's the responsibility that comes to take care of your land, aina, and the people. And it's also a privilege, not just a responsibility.
Absolutely. I look forward to, hopefully we can inspire viewers and listeners to change their mindset towards that positive systemic change. Tensie, I want to ask you, because the Center for Sustainable Business helps business leaders to embed sustainability core to business strategies. And your research says that this not only is better for societal performance, but it can lead to better financial performance. Can you speak to that?
Absolutely, be delighted to. And I just want to say also, I fully concur with what Charlie had to say. So what we're seeing is that the conventional approach to corporate behavior, production, consumption, et cetera, is dependent, as Charlie said, on natural resources that are rapidly disappearing, on an outdated understanding of risk, on things like the impacts of climate change, on human and crop productivity, on transport, on insurance, on everything else. The sort of challenges around not taking care of our people well, and exploitation leading to problems for the business as well as for society. So we've been analyzing what actually are the drivers of better financial performance. We looked first at kind of across the board. We analyzed more than 1,000 academic studies looking at the correlation between financial performance and corporate performance and investor performance between 2020 and 2015. We haven't published this yet, a quick update since. What we found is that 58% of the studies found a strong positive correlation between sustainability and corporate financial performance. And we found that on the investor side, 33% of the studies found that sustainable investing outperformed conventional. 33% found it operated at par. There were definitely studies, I think there was something like 12% of studies or 14% that found a negative correlation on the investor side. There's real challenges with the studies like that, though, which we fully agree with, which is that these are correlations, not causality. But then we developed a methodology called ROSI, Return on Sustainability Investment, where we're looking at the causality. And I know we can talk more about that later, but we've identified 9 mediating factors that drive better financial performance when you do embed sustainability core to business strategy, ranging from innovation and growth to operational efficiencies to risk mitigation to employee engagement to supplier resiliency, et cetera. All things which you can improve through better management. But what we're seeing is that sustainability is now a way to really drive better and improved management. How that translates into investing, final point I will make here, is that for investors, right now, most are depending on ESG reporting metrics to do the ESG investing analysis. Those ESG reporting metrics are problematic because they're based on process and output-based metrics. Things like, do you have a policy on X? Have you trained X number of people? None of those things actually drive better performance, either from a societal perspective or a financial perspective. They could, but I have no idea whether a policy on chemical management is actually driving improvements that would result in lower risk, more operational efficiency, and competitive advantage. Whereas an apparel company that's developed a bio-based dye, I can absolutely determine what the financial benefit is. So investors need to get beyond these ESG reporting metrics to look at the underlying thesis around what are the drivers of better financial performance and which companies are better managed and have a sort of competitive moat associated with those improvements that they're making that are really robust in improving the business.
Thank you for that. Andrew, I know that you have looked at a lot of mutual funds and different choices that investors can, or I guess different vehicles that investors can use. Can you talk about that? And maybe what are the differences between socially responsible investing, SRI, impact investing, and ESG investing?
Sure. Well, thank you very much. So just to, as you saw, as a 501c3, we're a nonprofit. So we do a great deal of research at a company level. We're looking at 3,000 companies on racial justice and DEI across 61 key performance indicators and updating it quarterly. So I take what was said before about ESG data is very, very important that we do our own research, basically. And because a lot of the data that's being put out by the companies is often misleading. There's very little rules or enforcement around companies that and how they communicate with their shareholders in terms of material disclosure. So you got to get to the core of what's really going on. And the good news is that there's some new metrics that are being developed in Europe, CSRD it's called, and CSDDD, that are being put into, going to be rolled out in the next 6-10 months or so. And what we're going to be seeing is 49,000 European companies and 10,000 US companies are going to be starting to report and disclose in a standardized format. They're going to be required to have third-party verification. And so we're about to come into a whole new era of environmental, social, and governance data that's going to be able to guide shareholders to identify who are the best management teams. Ultimately, when you invest, you're investing in a management team. And the folks who can assess and address risk are going to be the ones you want to overweight in your portfolio, because they're most likely to be able to, like, for instance, look at climate change. And they're going to say, right now we're seeing what we call climate inflation, that there's no olive oil, for instance, coming out of Southern Europe because of a heat wave. There's no British Columbia just lost their entire vintage of grapes. Cacao, chocolate prices doubling because of climate. These heat waves are disrupting the production. So cotton, Pakistan floods, Texas, there's droughts. So the teams who are adjusting, who are assessing the risk, adjusting to the risk, that's the companies who you want to put your money into, as opposed to there's a lot of companies that just say, we're ignoring it, and I can talk about this more later, but there's been a whole anti-ESG crusade that's been very well funded by the oil companies and by this far right group that is making it illegal in some states to assess and address risk. If you can get your head around that, literally those 18 states that have now adopted those laws, all of their pension funds are underperforming. The companies the banks that would be funding municipal bonds in those states are no longer allowed to do business in those states because they have a climate transition plan. So all these states are paying more money for their bonds. And so there's this whole attempt to make it political, when really what this is about is just picking the best management teams that are going to be assessing and addressing risk. So I didn't answer your question, but we evaluate 6,000 mutual funds every month on a range of different environmental, social, and governance topics. And it's called investyourvalues.org, open to the public. You can go there, type in any mutual fund or ETF, and you will get a ranking for it. And then we aggregate those up for 401k plans for about 60 companies now. And we will continue to build that out.
Any advice for how an investor can go to that website and choose? Like, how do they choose what best aligns with their values?
Well, basically you go in there and there's a pull down menu and you can say, what do I care about? I care about climate change. You have to get at least a B on climate change, and you have to get at least an A on private prisons or gender equality. You can put in whatever grades you want, and then it sorts through 6,000 mutual funds and ETFs, and we'll put the ones at the top that get the better scores, and then you can compare their financial outputs over the last 10 years. So, for instance, if you're looking for a target date fund, you can say, show me the Vanguard, Fidelity, BlackRock, and Natixis, which is a sustainable one, target date fund, a 2050 target date fund. You can see the scores, and you can see the sustainable one is going to be getting better scores, and it happens to also outperform over the past 5 to 3, all of the years. They've outperformed all the other target date funds. So if your company's offering you various target date funds in your 401k plan, you'd say, well, you know what? I actually want to have a livable planet and I want to make more money. I choose that particular one. So it's very simple to use.
A helpful resource.
Yeah.
Kanzi or Charlie, anything to add on the Sustainable Investing 101? Okay, with that, let's go to segment 2.